Welcome to Value Vest Daily. Today we are tearing into a full, comprehensive, deep dive update on HIMS and HERS Health. You probably know them by their ticker, HIMS. We're going to peel back the layers on this massive consumer-first telehealth platform to figure out exactly how their deep medical science and proprietary tech moat are translating into what looks like an explosive valuation. We are talking about staggering subscriber growth, their freshly updated Q1 2026 earnings, seriously raised full-year revenue guidance, and a totally game-changing strategic pivot in the weight loss drug market. But honestly, what's most exciting is their aggressive international expansion strategy. This is the piece that could literally turn HIMS from a US favorite into a true global powerhouse. We're going to give you the comprehensive details you need as an investor to really grasp the science behind their platform and the massive addressable markets sitting right in front of them. Just a quick heads up before we get our hands dirty. This explainer is strictly for educational purposes and is not financial or tax advice. You know the drill. Markets are volatile, past performance doesn't guarantee future results, so always do your own research and consult a professional advisor before you actually put your money to work. All right, grab your notebook, settle in, and let's unpack the numbers, the science, and the real investment case here. Okay, look at this number right out of the gate, 969%. That is not a typo. That is their year-over-year international revenue growth for the first quarter of 2026. They literally went from just $7.3 million to a massive $78.2 million. That single line item tells an absolutely huge story about where this company is heading. And to understand how they managed to pull off that kind of hypergrowth, we have to look at the complete picture. So here is our roadmap for today. First, we'll break down that Q1 2026 momentum. Then we'll look at the science of telehealth, their global expansion strategy, their forward guidance and scale, and finally, we'll run a DCF valuation to see if the stock is actually a buy. All right, part one. Let's dive right into their Q1 2026 momentum and revenue strategy. What is really fascinating here is the total dichotomy between their domestic and international markets. If you just glance at it, a 4% total revenue growth to $608.1 million might look kind of modest to a high-growth investor. But if you dig just a little bit deeper, you see a brilliant strategic pivot playing out. U.S. revenue actually dipped by about 8% year over year. Why? Because management deliberately shifted away from compounded GLP-1 weight loss drugs, pushing their platform instead toward branded options, specifically Novo Nordisk's Wegovy and Ozempic. They took a short-term hit for long-term consumer trust and supply chain consistency. And juxtaposed against that intentional dip is the rest of world revenue explosion to $78.2 million. That 969% growth proves that while the U.S. is in a strategic transition, their international engine is absolutely firing on all cylinders. And listen, this strategic pivot is propped up by what we can confidently call elite unit economics. HIMS is now flexing a massive subscriber base of nearly 2.6 million, which is up 9% year over year. But you know what? The most crucial metric here isn't just how many people they acquire, it's how many they keep. They are maintaining a rock-solid 85% plus long-term retention rate. Because these patients stick around month after month, the payback periods on new customer cohorts sit at under 12 months. Let's be real. In the digital health and direct-to-consumer space, getting your entire customer acquisition cost back in under a year while retaining the vast majority of those users, that's the holy grail of profitability. It essentially means the platform is funding its own growth within a single calendar year. Which brings us to section 2, the science of telehealth. Let's peel back a layer and look at the actual medical science that makes these subscriptions so sticky. Let's start with weight loss, because that's a massive focus for them right now. According to CDC data, obesity affects over 40% of U.S. adults, and it drives over $200 billion in annual healthcare costs. This is a massive problem. HIMS is attacking this using GLP-1 receptor agonists like semaglutide and tirzepatide. Now, these aren't your sketchy fad diets from the 90s. These are rigorously, scientifically proven medications. They work in a step-by-step biological process. First, they mimic natural gut hormones, then they physically slow down gastric emptying, and dramatically boost the patient's feeling of satiety while regulating blood sugar. As proven in massive clinical trials like STEP and SURMOUNT, these exact mechanisms safely deliver a 15 to 20% average body weight loss. That is life-changing science. And this brilliantly illustrates their broader scientific foundation. They don't just do this for weight loss, they apply this exact same rigorous science-backed playbook to other high-demand areas. Take hair loss, for example.
They combine finasteride and minoxidil to specifically target the exact DHT pathways that cause follicle shrinkage. And for erectile dysfunction, they utilize PDE5 inhibitors to physically improve blood flow. By taking proven science and wrapping it in a totally seamless, stigma-free consumer interface, they remove all the friction from accessing top-tier medical care.
So the huge takeaway here, the real aha moment, is that HIMS is not just a digital pill dispenser. They are a fully vertically integrated platform that structurally solves healthcare's three absolute biggest barriers: access, affordability, and adherence. They make these complex treatments accessible at incredible scale by layering in continuous behavioral coaching and at-home labs for metabolic health. That ensures that patients don't just get handed a prescription and forgotten about, but actually adhere to the treatment and see real, measurable results. All right, part 3. Let's look at their global expansion strategy and see how this builds into a multi-billion-dollar catalyst. They are literally building an empire here, and this timeline maps out a highly disciplined, acquisition-accelerated global rollout. International revenue is already 13% of their total revenue, and obviously it's growing at triple digits. First up is Europe via the Zava acquisition in 2025, which secures them an established digital pharmacy presence in the UK, Germany, France, and Ireland. Next, they enter Canada via Livewell in late 2025. Then comes a massive, massive catalyst, the launch of generic semaglutide in Canada in 2026. That will make Canada the first major market globally for affordable GLP-1s. And if that wasn't enough, by mid-2026, they have the pending eucalyptus acquisition for up to $1.15 billion, which adds Australia and Japan to the map. Combined, this master plan unlocks an addressable adult population exceeding 600 million people. It positions their international operations alone to scale to over $1 billion in annual revenue within the next 3 years.
But how do you scale globally without breaking the bank? The secret sauce powering this, while keeping those elite unit economics intact, is their proprietary technology stack, MetaMatch AI. When you're dealing with millions of patients across completely different regulatory environments, you need profound efficiency. MetaMatch AI analyzes millions of data points, everything from at-home labs to symptoms to genetics, to precisely match patients to the right treatments. Internal studies show this AI achieves greater than 90% provider agreement. By doing all that heavy lifting of triage and personalization upfront, it seamlessly reduces provider burnout and cuts costs by a massive 40 to 60%. I mean, just imagine traditional brick-and-mortar clinics trying to compete with those kinds of margins. There's just no way. Let's move to Section 4 and see how this science and global scale translates into their forward guidance and scale. Because of all this momentum, management is not being shy here. They have aggressively raised their full-year guidance. They've bumped FY 2026 revenue up to a range of $2.8 billion to $3.0 billion. That represents 19 to 28% growth. Q2 alone is guided at $680 to $700 million, which shows a clear acceleration as that branded weight loss pivot really starts gaining serious traction. Adjusted EBITDA guidance was updated to $275 to $350 million, reflecting a really strong margin. And listen, even after absorbing a $33 million restructuring hit in Q1, their long-term target is what really turns heads. They are projecting at least $6.5 billion in revenue and $1.3 billion in adjusted EBITDA by 2030. Think about that. That is roughly 2.5 times the size of the company today. Finally, Section 5. The million-dollar question. Let's run a DCF valuation. Is this stock actually a buy right now?
So the stock is sitting around $25 right now post-earnings, giving HIMS a market cap of roughly $5.7 billion. Now, the stock did dip slightly on recent EBITDA updates due to those one-time restructuring costs we just talked about, but we really need to figure out, is this massive transition into a multi-billion-dollar global platform already fully priced in at $25? To figure that out, we ran a discounted cash flow model, keeping things pretty conservative. Here are the 5-year assumptions we fed into it. We took the $2.9 billion revenue midpoint for FY 26, growing that to their $6.5 billion target by 2030. We modeled EBITDA margins scaling up from the current 11% to 20% plus, as those economies of scale and MedMatch AI efficiencies fully kick in. We modeled free cash flow conversion at about 65% of EBITDA, and we applied a 9.5% weighted average cost of capital, paired with a very standard 4% terminal growth rate. When we run those numbers, the underlying math becomes incredibly compelling. Our base case model yields a fair value of approximately $32 to $37 per share, with the stock currently trading around $25. That implies a massive 25 to 50% upside from current levels.
Even if you use much more conservative assumptions for a slower international ramp, the stock still shows as fairly valued to slightly undervalued. And if you look at the bull case, which would be driven by even faster GLP-1 adoption globally and maximizing those AI efficiencies, that pushes the fair value north of $45 a share. So based on the DCF model, HIMS looks like a resounding buy for long-term growth investors who can stomach a little near-term margin noise to capture what looks like a durable competitive advantage in a $100 billion plus global telehealth market.
But hold on, to be a smart investor, you must always look at the downside and prepare for near-term risks. Nothing is a sure thing. First, we have to watch for potential regulatory shifts and crackdowns on compounded drugs. Now, they are proactively mitigating this, but it's a risk. Second, global supply chain constraints for GLP-1 medications remain a frustrating industry-wide headwind. And third, plain old execution risk. Integrating massive international acquisitions like Eucalyptus and Zava is highly complex and requires absolutely flawless execution by the management team.
So I'll leave you with this final thought. HIMS isn't just riding a short-term weight loss wave. They are structurally building the Amazon of personalized consumer health. So the question is, do the massive AI efficiencies and those rapidly spinning international flywheels outweigh the regulatory headwinds on compounded drugs? Look at the data and let us know what you think in the comments. Please subscribe, like, and share ValueVest Daily for daily learning opportunities before you put your money to work. And one more thing, please put in a comment if you want us to deep dive into any specific high-risk/reward opportunities next. Until next time, stay curious, stay disciplined, and invest with conviction.